TSS and BTE have joined forces.
Context,
Power.
edge.
The new paradigm of trading.
So, if we look back at late July 2026, the global macroeconomic picture was, well, it was genuinely terrifying.
Oh, yeah, absolutely terrifying.
I mean, you had the threat of war, which caused oil prices to just plummet like 7% on those fresh peace talks.
Right, and the Federal Reserve was basically completely cornered right before their FOMC meeting.
Exactly. And on top of all that, the 30-year Treasury yield hit this blistering high of 5.21%.
Which is huge.
It is. By all traditional economic logic, the stock market should have completely cratered.
But it didn't. Instead, out of nowhere, AI and crypto stocks just violently exploded upward, nearly 30% in a single day.
Which is just insane. And the media coverage was almost comical in how certain they were about it.
Oh, they were shouting from the rooftops that the AI boom was back.
Right. They were telling anyone who would listen that the fundamentals had just, magically shifted overnight.
Yeah, that retail investors needed to buy in immediately before they missed the bottom.
And if you're sitting at home watching this, you're probably experiencing massive FOMO. But what if that entire narrative, that triumphant return of the AI bull market, was a complete and total illusion?
Which, spoiler alert, it absolutely was.
Right. And that's our mission for this deep dive. We're opening up a stack of private daily market logs and founders' notes from SpotGamma.
These cover July 27th to July 31st, 2026.
Yes, and we are going to uncover how hidden market plumbing, not economic news, engineered a completely fake market rally.
It's such a crucial autopsy of that week, honestly, because it fundamentally breaks the way most people are taught to invest.
Okay, let's unpack this, because the best way to think about it is the difference between the weather and a machine.
I like that analogy.
Thanks. Because most investors, they treat the stock market like a weather report.
Right, they assume the news is the weather.
Exactly. The inflation data, earnings from companies like Meta and Amazon, geopolitical events, they think that weather organically causes the market to go up or down.
But these SpotGamma sources show that the market is actually just a giant mechanical engine.
Yes, and during that last week of July, the gears and levers of that engine were forcing the price action, completely blind to what the weather was doing outside.
Well, to understand why the market ignored the actual news, we really have to look at the physical boundaries that were trapping it.
Right, because Meta dropping 11% while Amazon gained 11% didn't actually matter to the broader index.
Exactly. The S&P 500 wasn't free-floating. It was boxed into a specific mathematical grid.
And according to the SpotGamma logs, going into that week, the S&P 500 had a strict, what they call a risk pivot.
Right. A risk pivot defined at the 7,450 level.
I want to stop right there, because 7,450 isn't just some random line drawn on a chart. It has to do with options dealers.
Yeah, the big Wall Street institutions that facilitate all the options trades.
But mechanically speaking, why does their positioning at 7,450 dictate whether the entire stock market crashes or rallies?
Well, it comes down to a metric called gamma, and more specifically, how these dealers manage their own risk.
Because they don't want to actually gamble on the market's direction.
Right, exactly. Options dealers don't want to gamble on the stock market going up or down. They just want to collect transaction fees.
But when they sell an option to an investor, they take on risk.
Right, and to neutralize that risk, they have to constantly buy and sell shares of the underlying stocks. It's a process called delta hedging.
So they're essentially covering their tracks in real time as the stock price moves.
You got it. Now, above the 7,500 level on the S&P 500, the SpotGamma notes show the market was in a state of positive gamma.
Okay, so explain positive gamma for a second.
When dealers are in positive gamma, the math forces a very specific behavior. If the broader market starts to rise, the options they've sold change in value.
Right.
So their models force them to sell stock to remain neutral. And if the market starts to fall, their models force them to buy stock.
Meaning they are basically acting as giant automated shock absorbers.
Yeah, exactly. Every time the market tries to make a big move in either direction, this massive wall of institutional capital steps in and pushes it back toward the middle.
They buy the dips and sell the rips, which basically suppresses volatility.
That's the dynamic above 7,500. But like we said, the risk pivot was 7,450.
Right.
Below that line, we cross into a highly dangerous zone called negative gamma. And here, the mathematical mechanics of the options dealers completely invert.
See, this is the part that bends my mind a little bit. How can the math just reverse?
It's because of the types of options that dominate below that strike. In negative gamma, dealers are overwhelmingly short put options.
Okay.
So if the price of the S&P 500 falls, the dealer's exposure to losses accelerates rapidly.
Oh, to hedge that accelerating risk.
They are mathematically forced to sell the underlying stock.
Wait, so the market is falling, and to protect themselves, they have to sell stock, which just pushes the market down even further.
Yes, which means the risk increases again, forcing them to sell even more stock. They go from being shock absorbers to being massive amplifiers of volatility. And the same thing happens if the market rises, they are forced to buy, accelerating the rise.
So in negative gamma, the market just becomes wildly unstable.
Exactly, because the dealer flows are moving with the momentum instead of fighting against it.
Okay, I used to think of negative gamma like driving on a freshly paved highway, hitting the 7,450 risk pivot, and suddenly hitting a sheet of black ice on a downhill slope.
It's a good visual.
But based on what you're saying, that analogy actually falls a bit short. On black ice, you just slide. What you're describing is a feedback loop.
Right.
It's like hitting black ice, but the further you slide, the heavier your car gets, pulling you down the hill faster and faster.
That is a much more accurate way to visualize it. It's an avalanche.
Yeah.
And the reason this should completely change how you view a red day in the market is that these violent price drops aren't driven by human investors thoughtfully deciding the economy is in trouble.
Right. The selling is forced by algorithms executing math to balance their books.
Exactly.
So if that 7,450 line is the edge of the cliff, what actually pushed the S&P 500 over it? Because the sources give us a play-by-play of the exact moment the ice broke during that super week.
Yeah, the macro weather finally got too heavy. On Wednesday, July 29th, following the Fed's FOMC meeting, the 30-year Treasury yield just surged.
It jumped to roughly 2.2% on the day, right?
Yes, hitting that 5.21% mark, which was its highest level of 2026.
And high yields act like gravity on stock valuations.
Precisely. That intense pressure forced the S&P 500 to break cleanly below the 7,450 risk pivot.
And once it broke that line, the trapdoor opened. The S&P 500 plunged to 7,316, which was down 1.5% for the session.
It was a brutal drop.
But here's where it gets really interesting. I want to pull a specific observation out of the SpotGamma PM note from earlier in that week.
Go for it.
On Monday and Tuesday, there was this massive 9,000 lot put spread down around the 7,385 level.
Oh, right, the massive floor.
Yeah. For a couple of days, that giant position was acting like a concrete floor for the index.
Let's explain why that acts as a floor for a second. A massive player bought 9,000 put options at that 7,385 strike, meaning dealers had to sell them.
Right.
As the market price drops towards 7,385, the dealers are on the hook. To hedge their risk, they have to buy the underlying index.
So naturally, that aggressive dealer buying creates a temporary floor.
Exactly.
But the notes highlight that once the macro data hit on Wednesday and pushed the market fully into that negative gamma avalanche, that 7,385 floor completely rolled over.
It gave way entirely.
Right. But if the dealers were buying to hedge, why didn't the floor hold?
Because the forced selling from the broader negative gamma cascade simply overwhelmed it.
It was just too much volume.
Exactly. The spot gamma data flow shows that as the market fell deeper into this zone, broader equity selling pressure just dwarfed the localized hedging at 7,385.
Wow.
Heading into the close on Wednesday, the math forced options dealers to sell roughly $6 billion in equities in just a few hours.
$6 billion of mechanical selling. That just bulldozes right through massive institutional defenses.
Without a doubt.
So if we pause the timeline right there at the end of Wednesday, the market just fell off a cliff into a negative gamma feedback loop.
Bond yields are at 5.21%, which is absolute poison for tech valuations.
Everything looks incredibly grim. But then we wake up on Thursday, July 30th, and we see one of the most violent upward spikes in modern history.
It's a massive contradiction. I mean, on Thursday, the semiconductor index, the SOXX, rebounded 9%.
And individual names were even more aggressive. Microsoft surged 16%.
Yeah, adding nearly $500 billion in market cap in a single session.
Which was its biggest one-day gain since October 2008. Semiconductor and crypto mining names went absolutely ballistic.
Sandisk was up over 24%. Cipher mining, CIFR, was up 28.3%.
And this brings us to the core revelation of this entire deep dive. If the plumbing is broken and the macro data is terrible, why on earth did AI and tech stocks suddenly skyrocket?
Right. You look at those numbers and you completely understand why CNBC and FinTwit immediately declared that the AI trade is back.
They were saying the fundamentals are completely intact.
Because human beings crave narrative. We see a price go up and we demand a story to explain it.
But the SpotGamma logs reveal the absolute truth of what happened that Thursday.
And it had zero to do with an organic belief in AI's future. The entire rally was a mechanical illusion.
Okay, so what was the actual ghost in the machine?
A massive hedge fund called Situational Awareness, or SA, had collapsed.
Wait, really?
Yeah. The market volatility and the negative gamma bloodbath on Wednesday had basically destroyed their positions. They were quietly liquidated.
Wow.
And a giant fund, Citadel, stepped in and took over SA's entire book of stocks.
Wait, hold on. Citadel wasn't buying these stocks because they suddenly had a revelation that AI is underpriced.
No, not at all.
They were just executing a financial bailout.
Exactly. It was a forced mechanical transfer of assets. Citadel didn't buy because of a new economic thesis.
They bought because they were absorbing a liquidated portfolio.
Exactly. And when you force billions of dollars of buying across a very specific concentrated cohort of stocks, you create a massive artificial price spike.
Especially the high beta AI and infrastructure names that the SA fund happened to hold.
Precisely.
The sources actually have this incredible chart showing the single-day percentage moves of the exact stocks Citadel bought from situational awareness.
It's just a wall of blue bars.
Right. It's showing 20% to 28% gains for stocks like CIFR, IRN, and SNDK.
Meanwhile, large-cap tech stocks that weren't in that specific portfolio barely moved.
NVIDIA was up less than 2%. Apple was down.
Exactly. If it was a real AI boom, NVIDIA would be leading the charge, not lagging behind random crypto miners.
What's fascinating here is how reflexivity works in modern markets.
Right. Citadel buys the SA portfolio mechanically via massive block trades.
And this sudden buy order forces the prices of those specific stocks to gap up.
Then, algorithmic trading systems, which are programmed to front-run momentum, detect the sudden volume and start buying too.
And then retail investors wake up, check their brokerage apps, and see SNDK up 20%.
And they don't know about the secret Citadel bailout.
Right. They just see the green on their screens. They assume someone knows something good, and the fundamentals must be improving.
So they start buying in out of pure FOMO. This creates a self-fulfilling prophecy.
The mechanical liquidation triggers algorithmic buying, which triggers emotional retail buying.
The price shoots up, and then the financial media looks at the high price and reverse engineers a headline to justify it.
AI is back.
Exactly. Price creates the news, not the other way around.
Price defines narratives. That is a direct quote from the Friday morning SpotGamma note, and it is chilling.
It really is.
It means you could be risking your retirement savings based on a CNBC headline that was literally generated by a single hedge fund going bankrupt.
It is the absolute definition of trading inside a hall of mirrors. And the SpotGamma notes highlighted an underlying indicator that proved the broader macro situation was actually getting worse despite this shiny tech rally.
Right. They tracked something called KO1M.
The one-month correlation metric. The logs called it a red alert zone when correlation drops below 8.
Why does that metric matter so much here?
Well, KO1M measures the correlation of the top 50 stocks in the S&P 500, basically how closely they are moving together.
Okay.
For months, AI stocks were completely disconnected from the rest of the market. They just went up, ignoring everything else, which caused correlation to drop artificially low.
But during this super week, correlation started moving back up.
Meaning the underlying stocks were starting to move together again.
Yes, they were moving together downward, driven by the fear of those 5.21% Treasury yields.
The broader market was still selling off.
So the manic AI upside chase was effectively dead, but it masked its own death with a one-day liquidation spike that tricked everyone into thinking the rally was broadening out.
Exactly.
Okay, so if media narratives are just backward-justified headlines and the market is just a cold algorithm liquidating portfolios, how do I not get run over?
That is the million-dollar question.
If you are holding stocks in an environment like this, what is your actual move?
Right.
Because these sources don't just diagnose the problem, they offer a structural solution. Let's talk about defense.
It starts with completely changing how you view market entries and exits. The SpotGamma team emphasizes a concept we can call risk pivot sizing.
Okay, how does that work?
You stop trading based on whether you think the Fed will cut rates, and you start trading based on where the index is relative to dealer positioning.
Or so using that 7,450 SPX line as a literal switch on your dashboard.
Exactly. When the S&P 500 is trading comfortably above 7,450 in positive gamma territory, That is when you can look for growth.
That is when you can confidently hold your long positions.
Because you know the dealers are acting as shock absorbers beneath you.
But the second it closes below that line.
You must aggressively cut your long positions. You are now in the avalanche zone. The math is flipped.
Right.
Do not try to catch a falling knife when dealer gamma is negative. It does not matter how cheap a stock looks fundamentally.
Because if forced dealer selling is pushing the market down, fundamental value is entirely irrelevant until the mechanical selling is finished.
Precisely. Cut your risk when the guardrails disappear.
That makes sense on the surface.
Yeah.
But the sources also extract a very specific, actionable options strategy for those who want to actively protect their portfolios during these chaotic super weeks.
Yes, it's called a put fly or a put butterfly.
But before we get into the structure of a put fly, let me ask the obvious question. Why not just buy standard insurance?
Right.
If I know the Fed is speaking on Wednesday and the market might drop, why shouldn't I just buy a regular put option on Tuesday to protect my portfolio?
Because it is incredibly expensive, and you will likely lose money even if you are right about the market dropping.
Wait, really? How?
It all comes down to implied volatility. In options pricing, fear is measured by implied volatility.
Okay.
Right before a massive event like FOMC, fear is high, which means implied volatility is high, causing options premiums to skyrocket.
So the insurance company is jacking up the rates because they know the storm is coming.
Precisely. If you buy a standard put option to protect your portfolio right before the event, you are vastly overpaying for that fear.
I see.
And here is the kicker. Once the Fed announcement happens, the event has passed. The uncertainty is gone.
So fear instantly drops.
Which causes implied volatility to collapse. This is known as volatility crush.
Oh, wow.
Even if the market drops like you predicted, the volatility crush deflates the premium of your options so much that your put loses value anyway.
It's literally like trying to buy hurricane insurance while the Category 5 storm is already hovering off the coast.
Exactly.
You pay an astronomical premium, the storm hits, but the insurance company says, well, the uncertainty is gone, so your policy is worthless now.
That is a great way to put it.
So how does the put fly solve the volatility crush problem?
It's a structured trade that drastically reduces your upfront cost by pinpointing the exact mathematical drop zone.
Okay, break that down for me.
In the Wednesday morning note, they outline an example structure for the Friday expiration. It involves 3 legs.
Right.
First, you buy one put option at the 7,200 strike. That starts your insurance payout if the market drops to 7,200.
Okay, that's the first leg. That makes sense.
Second, to pay for that expensive put, you sell 2 put options further down at the 7,000 strike.
So by selling those 2 puts, you collect premium from the market.
Exactly, which finances the put you just bought at 7,200.
But wait, Fervin's put exposes me to risk if the market crashes below 7,000, right?
Which is exactly why there is a third leg. To protect yourself from a catastrophic world-ending crash, you buy one final put at the 6,800 strike.
Okay, I love this because it perfectly mirrors how real-world insurance works when you negotiate.
Right.
It's exactly like buying flood insurance for your house, but to get a massive discount on the premium, you make a deal with the agent.
Tell me more.
You agree that the insurance only pays out if the floodwater hits the second floor of your house. That's the 7,200 strike you bought. But you agree the payout caps out and stops paying before the water hits the roof. That's the 7,000 strikes you sold.
That is a brilliant way to map the mechanics. You are drastically lowering your cost up front because you aren't paying for general open-ended panic.
You are using the SpotGamma data to pinpoint the exact negative gamma drop zone.
In this case, targeting that high probability slide towards 7,000.
And you structure your insurance to only pay out if the market falls exactly into that mathematical pothole.
Exactly. You use the market's own mechanical levels to finance your defense, insulating yourself from the volatility crush.
That is just incredible. So what does this all mean for you listening at home?
That is the big question.
If we zoom out from the gamma levels, the option structures and the hedge fund bailouts, the core lesson from this week in July 2026 is a massive paradigm shift.
Giant volumes of forced capital, whether it is coming from options dealers delta hedging their books or giant funds being aggressively liquidated, can and will completely invalidate traditional economic data.
The biggest practical takeaway is identifying the illusion.
Yes. When an anomalous basket of completely unrelated stocks, say an AI software company, a crypto miner, and a legacy memory chip maker, all shoot up 25% together for no apparent reason while the broader market is bleeding, it is almost certainly a liquidation.
It is a mechanical transfer of wealth. It is not a trend you should be blindly buying into.
Because, as we said, price creates the news.
Exactly.
And if we connect this to the bigger picture, it raises a rather terrifying question to leave you with.
Let's hear it.
In this instance, it was just one hedge fund, situational awareness, that failed. And yet, the liquidation of that one fund violently distorted the entire tech sector.
It caused Microsoft to have its biggest day in almost 2 decades, strictly as collateral damage from a bailout.
And it entirely rewrote the mainstream media's economic narrative for a whole week.
It really makes you wonder how fragile the entire system actually is.
Precisely. Consider this. What happens when it isn't a relatively contained hedge fund? What happens when a massively popular, passively managed ETF holding trillions of dollars of retail retirement money faces forced mechanical liquidation right at the exact moment the S&P 500 falls below the risk pivot into negative gamma?
Wow.
Are we all just trading inside an automated machine where the economic fundamentals no longer matter at all?
Are we trading the weather, or are we trapped in the machine?
It really makes you think.
It's a question that should completely change how you watch your screens on Monday morning. Don't let the headlines fool you. Look past the weather report, watch the underlying plumbing, and always know where the risk pivot is. That's it for this deep dive.